So we're back with another video, and in this week's video, I'm going to be going over a company that has been in very heavy demand for me to review, particularly because the company at this point in time looks pretty expensive, especially relative to its growth. And I'm just going to dive into my thoughts on Apple, my overall outlook on Apple, and whether or not I believe the company is a little bit too expensive in a market that is no doubt frothy. Before we kick off the video, everybody, I just want to mention we're having an early Black Friday opportunity to get into Premium. This is a pretty great price. We're opening it up for 2 days. I will leave a link down in the description below. You can check out the platform. It comes with a 30-day subscription back guarantee. So if you're interested in getting my full portfolio transactions, all of our stock calls over at Premium Model Portfolios, we got the Discord, we got the Q&A, we have a brand new stock screener, grade 5,400 equities on 90 different metrics. It's going to be a platform that removes uncertainty, helps you to invest with more confidence, and ultimately saves you a ton of time. You can hop on that platform. I'll leave a link below in the description. And when you sign up, head into the Discord and shoot me a message. I'll be sure to say hi. So this is Apple's quarter from, I believe they reported end of October. Yeah, so they reported quarterly revenue of $94.9 billion, which is up 6% year over year. So mid-single digit growth, and diluted earnings per share was $1.64, up 12% year over year. So this was excluding a one-time cost. So these are adjusted earnings, but ultimately adjusted earnings up 12% year over year. And a lot of people are kind of confused as to how a company can trade at this high a valuation despite some pretty big headwinds. And what I want to do first is actually go over Apple's earnings segments and their overall revenue makeup. So when we go to Apple's product revenue, so this would be their product revenue on a trailing 12-month basis, we can see that they're pretty much reporting a third straight year of declines in product revenue. So we can see that they peaked in September of 2022, they declined in September of 2023, and they declined in September of 2024. So 2 straight years of declining trailing 12-month revenue. So the main reason for this, if we look leading up to the COVID-19 pandemic, we can see that product revenue absolutely soared in 2021. What happened in 2021? Well, the pandemic hit. We were riddled with lockdowns, interest rates, practically free money to lend. So a lot of consumers were spending much more money on products. We can think of, in terms of Apple products, we can think of the Apple Watch, we can think of the iPad, we can think of the iPhone. But once interest rates started to accelerate in 2022, we're now seeing 2 straight years of declines in product revenue. And why is this? Well, a bit of an aspect of it right now is people just are not willing to continue paying for brand new devices that really don't bring on that much added functionality. Apple has been criticized for a very long time on pushing way too many phones out that are really not justifying the price over the previous phone. So during a time where, discretionary spending is high, like it was during the COVID-19 pandemic, you would see a lot of people spending, money. Maybe, they're still in their contract, they upgrade their phone, they buy a new device. Whereas now you're seeing a lot of people, when pennies are tighter, they're saying, hey, maybe I don't need to spend $1,200 on a brand new device to get a, minorly increased quality in camera. Maybe I can hold on to that lower device because I don't have that much excess capital right now in order to spend. I'm trying to pay my mortgage. I'm trying to buy groceries. I'm trying to minimize my debt now that the interest rate on that debt is a lot more expensive. So as a result, we're seeing an overall decline in product revenue. And when we go to the actual specifics, so when we dig into something like their wearables revenue, so again, we're seeing it peak during the COVID-19 pandemic, a ton of people spending money, and now we're seeing 2 straight years of declines. When you think of Apple's wearable products, you're thinking of AirPods and Apple Watches. That is what drives a significant amount of this segment's revenue. And when we can see it, people just aren't willing to spend that much money at this point in time. So we're seeing a big decline in revenue. We're talking $41 billion in 2022, down to $37 billion in 2024, trailing 12 month. So when we go to the other segment that's lacking, that would be their iPads. Now, obviously, when we look way back, we can see when the iPad was first brought out, revenue, started to soar. They lost popularity, and then popularity came back, obviously, during the pandemic in a big way. I mean, we're seeing from 2020 to 2021, you're talking about like a near 33% increase in revenue, but now we're just reporting a consistent decline. I mean, even before interest rates started rising, the popularity of the iPad started falling. The one main thing with the iPad is there is a crazy amount of competition on the tablet market, and a lot of people likely aren't finding the iPad as a better product over and above, because the one thing about Apple is its products are crazy expensive. There is no doubt about it. And a lot of tablets are being utilized for businesses nowadays. It's not just personal use, but the one thing about it is the functionality of numerous other tablets is kind of up there with Apple. Maybe you lose a bit of functionality, but you're also paying significantly less in terms of overall price. So their iPads are under a ton of pressure right now in terms of sales. When we go to iPhone revenue, this is kind of what is holding the business up right now. Apple does have a dominant share in the smartphone market. They're some of the best smartphones you can buy. And as a result, revenue has remained relatively steady. We're looking at September 2021. They peaked in September 2022 at $205 billion. And now they declined in 2023 and are now staying steady in 2024. So this is going to be the main driver for the company. It's going to be, I would argue, the Modi end of the business. I mean, the iPhone sales, they've been relatively strong, especially in an environment where people are just not spending a ton of discretionary capital. But the one thing about it is they need this segment of the business to grow, to continue growing. And I'll go over how fast its services segment is growing in just a bit, but ultimately they need this area of the business to return to growth in order to really, fuel long-term earnings growth. And as of right now, it's just relatively flat. It's not performing all that well. I don't expect it to perform all that well, but they definitely do need this segment of the business to pick up again. And it probably will during falling interest rates. It just depends on how much. So when we go to its services segment, this is going to be the area of the business that is actually growing at a pretty rapid pace. We can see, since September 2012, they've grown it at an 18% CAGR, which is very impressive considering we're talking 12 plus year period to grow services revenue at that much. And for those who don't know what their service segment covers, it would be, the App Store. We're talking Apple Music, Apple TV, Apple News, Apple Fitness, their iCloud storage, Apple Care, Apple Pay, their Apple Card, things like that. So the company is still growing this segment of the business at a relatively quick pace. And, they're continually coming out with new products, new devices, a lot of which are subscription based, and you can buy bundles at discounted rates. It increases user retention, all that kind of stuff. And overall, just the innovation in this end of things in terms of developing new apps, new services, new products that people can buy, it's making this portion of the business relatively sticky. And it's also higher margin. So this is ultimately fueling a lot of the earnings growth for the company right now. But overall, I do feel there is a bit of issues in the company's core business, that being the devices. I'm really unsure of how fast this company is going to be able to grow if it doesn't pick up popularity in terms of its devices. Now, Apple has been trying to pick up its device sales by developing new products, and one of them would be the Apple Vision Pro. This device has generally been a disaster for Apple. It hasn't sold very well. They've revised their guidance continually downwards in the Apple Vision regard. I mean, look at the price, $5,000, or you can finance it at an 8% interest rate at $226 a month. This is the type of product that needs an absolutely perfect spending environment for anybody to buy this. People are not buying this product in this high rate environment. I mean, it's very obvious. The sales are not very strong right now. And overall, the newer products that Apple's coming out with at this point in time just really aren't driving any sort of earnings or revenue growth. When we go to the underlying numbers, we can see that revenue has effectively flatlined. And I mean, when we go down to free cash flow per share, it's pretty much, it dipped from 2022 to 2023, and now it's returning back to 2022 numbers. And there is a gradual slow intake in terms of free cash flow generated per share. And we're seeing earnings per share again. I mean, they're declining primarily because of some one-off costs, but effectively they have as well flatlined since 2022. When we see big spikes up, primarily due to the holiday seasons, things like that. But Apple really does not have a lot of underlying growth. I mean, we're talking single-digit growth. And the issue here is when we come to a valuation perspective, we're talking the company is trading at 37x trailing earnings, 32x trailing free cash flows. So the company typically over the last 5 years, during that huge COVID-fueled spending spree that a lot of people were going on, it traded at 28x earnings and 26x free cash flows. The company is trading at a premium to what it was trading at during the COVID-19 pandemic, despite not even growing as close. When we actually span this out to 10-year numbers, the company is trading at 37x trailing, as I mentioned, but its 10-year median average is 20.5x. And when we look to free cash flows, we're looking at 18.9x, essentially 19x free cash flow when it's trading right now at 32x. We're talking near 100% premium you're paying right now for Apple relative to what you've paid for it on average over the last 10 years. And what does this company provide at this point in time that justifies that valuation? I mean, it was growing at a much faster pace previously than it is now. And this isn't just my overall thoughts on this. I mean, we've seen Berkshire, they dumped a ton of their Apple shares. And make no mistake about it, it's still his largest position, but at one point this was near, 45% of its portfolio. Now it's trimmed down to like 26%. So they've dumped a ton of shares. And at the start, they said that it was, because of tax reasons, they started selling Apple. But I mean, they're dumping Apple at a crazy pace right now. It's hard to say whether or not they're done right now. I actually own Berkshire, which is why I've never owned Apple. I've gotten enough exposure to Apple through Berkshire Hathaway, but it's really difficult to tell where they go with this position. They clearly think it's overvalued. They said that it was because of tax reasons at the start of the year, but you don't dump 2/3 of your position in a company for tax reasons. It's clearly because they thought it was way too large of its overall portfolio, and they also think that it's pretty obvious they think it's overvalued to a degree. And another aspect I actually want to talk about with Apple is its agreements with Google. Now, what Google does is they pay Apple to the tune of $20 billion in 2022 to be the main search engine on iPhones. So this is effectively, it's pure profit for a company like Apple. So they will take that $20 billion, they show Google on Apple search devices, and ultimately Google benefits from this, Apple benefits from this. But the only thing is Google is being heavily scrutinized by the Department of Justice right now for monopolistic actions. This could be a very easy action they could take against Google to kind of reduce Google's monopolization of the internet, I guess you would say. So ultimately, these types of contracts would not be allowed. Apple would, whether or not they still show Google's search engine as a default search engine, that remains to be seen. But ultimately, they could easily can this deal, which, as it says here, Jefferies estimates a $25 billion deal makes up 20% of Apple's pre-tax profit, about 6.3% of total revenue, representing an 8 to 11% hit on share price. So this is a big element right now that I'm certainly keeping an eye on, and I think it's just something they could really, really easily do to essentially place some sort of action on Google for effectively having such a huge chunk in terms of the overall market share, in terms of advertising revenue, search engine revenue, things like that. So with Apple trading at these types of valuations, we're talking 27x forward earnings and a PEG of 1.6, suggesting that, the company is overvalued relative to its future growth. We can look at Apple's future growth estimates. They're expected to earn $7.39 relative to last year. That's low double-digit growth. And then, they're expected to earn around 90 cents of growth, which would represent, low double-digit growth again, and then, continually. So this is a company that's expected to grow in the low double digits moving forward. But the thing is many of the other technology options, we're talking Mag 7, we're talking Nvidia, Microsoft, Alphabet, Amazon, they're all expected to grow much faster than Apple, yet they trade at similar valuations. I mean, actually, if we go back here, we can see that Alphabet actually trades at a significant discount to Apple. We're talking about 23x earnings versus Apple's 37x. So, I mean, I would probably find Google a lot more attractive at this point in time. And I know there is the Department of Justice situation. There is the situation of AI replacing a lot of its search engine demand. But overall, I just don't see Apple as that attractively priced right now. It is very, very expensive relative to its growth. I mean, the DOJ in terms of Google, how, much that would impact earnings if that deal were to fall through. I mean, we look to their slowing sales on practically all their devices, and the only one I could really see seeing a big uptick moving forward on falling rates is probably the iPhones, the wearables, the iPads, the iWatch, things like that. I mean, they're very cyclical depending on consumer spending. And I mean, they could pick up if interest rates continue to decline and people start spending money again. But ultimately, I think we've seen a significant mindset shift from people because of that rapid increase in rates in 2022. And I just don't see people, even if rates decline, going out and, blowing all their money on devices like this as they used to pre-pandemic. I mean, the phones, ultimately, every single new model of phone that Apple brings out is really not all that much greater than the previous model. And I think consumers are really starting to pick up on this. And as a result, as you've seen, we've seen that product revenue, decline relatively steady for 2 straight years now. Overall, I think there are more attractive opportunities on the market relative to valuations. I mean, don't get me wrong, the vast majority of the US market is very, very frothy right now, but I just feel that there's probably better options moving forward than Apple, considering its overall valuation and just the overall risks associated with it. And I mean, obviously, we have Berkshire dumping all those shares. They're, ultimately going into cash. It's a very high percentage of their total assets relative to historical averages. And I mean, Apple was clearly pretty easy position for them to sell, just to shore up that cash balance in light of the markets being relatively overvalued. So that's it for the video, everybody. Head down below, like the video, subscribe to the channel, drop a comment, let me know what stock you want me to look at next. And if you're interested in Stocktrades Premium, again, we got that early Black Friday deal. I'll drop the link in the description below and you can sign up for that.